Is the US labour market cooling? Well, let's take a look at the data which was released from the US yesterday. The key event today will be the UK budget. We'll provide our assessment of the facts over the coming days through our media channel. If we turn back to the US for just a few moments, yesterday in the States we saw evidence of the labour market cooling. Job openings, so these are positions which are advertised but not yet filled, actually fell by around 418,000. So currently there's 7.2 million job adverts out there, and that's stepped down from August reading of 7.8 million. This is actually the lowest level which we've seen since January 21. Now, on one hand, this suggests that perhaps businesses have got less appetite to take on additional workers. This might also come through when we look at the quit rate, which is the number of people who are exiting their current roles. Quit rates at the peak of the post-COVID reposting was around 3%, and now it's below 2 at 1.9%. So people are staying put, despite there being ample jobs out there, 7.4 million in total. People are staying put because either the opportunities are unattractive or they're just a little bit uncertain about the future. So that's what the JOLTS data was telling us yesterday. On the other hand, we had the Consumer Confidence Index, which is a survey conducted by the Conference Board, and that actually ticked up. So it's sensing that consumers are quite optimistic about the future at this point. The numbers behind that, the index rose from 99.2 to 108.7. Now, our sense on all of this is we are seeing a cooling of the labour market. It's actually just normalising. It's still very healthy, still very strong. There's still a lot of people in employment and seeing pay growth, which is above the rate of inflation, but it is cooling down from that post-pandemic spike which we saw. And with the central bank on a pathway of loosening monetary policy, so reducing interest rates, this actually provides a tailwind to businesses to retain workers and to consumers as well to continue to get out there and spend. The consumer's vital to ensure that we don't have a more material slowdown in economic growth, because they actually make up around 60% of GDP in the US. So the pathway of interest rates to ensure that it's timed appropriately so we can allow the labour market to cool, easing some of those inflation pressures, but avoiding a more negative economic scenario is absolutely crucial. We saw bond yields pushed higher on the day, and we've seen quite a bit of volatility in the bond market over the last number of weeks, a negative return which came through in the bond market on the day. But equity markets still actually managing to push through some fairly decent returns given that backdrop of rising bond yields. And it's really the health of corporate America which is really helping this. We are at this point in the earnings season, and we're seeing some very constructive postings from some of the key businesses in the United States, particularly within the technology sector, but more encouragingly from a broader range of sectors as well, which is quite supportive of a more diversified equity market exposure. Thank you very much for watching, and please do tune in to our budget updates through the course of the week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.